Why is Latin America's largest economy, Brazil, slowing down? Today we investigate. Brazil boasts vast resources and a dynamic population, yet in mid-2025 its economic momentum is fading. The promise of rapid growth is slipping away, leaving investors and citizens concerned. This slowdown is not a single event, but a web of challenges. 5 critical issues are at play: sluggish GDP growth, high unemployment, steep interest rates, persistent inflation, and rising public debt. Each of these would be a problem on its own. Together, they form a powerful headwind. This affects everyone, from small shop owners in Saopaulo to major exporters in Mato Grosso. The numbers reveal missed opportunities and growing risks. We'll break down these issues in simple terms, providing a clear, data-driven explanation. This is more than numbers, it's about people's lives and futures. Brazil's resilience is being tested in this difficult moment. Join us as we examine the forces shaping Brazil's economy in 2025. We'll explore the causes, real-world impacts, and possible paths to recovery. Understanding these challenges is crucial for anyone invested in Brazil's future. Let's dive into the story behind the headlines. The stakes are high, and the outcome will shape the region for years to come. Stay with us as we unravel Brazil's economic puzzle. GDP is the pulse of any economy, and Brazil's is barely beating. In early 2025, GDP growth slowed to a crawl, a sharp contrast to previous years. This stagnation is widespread, affecting manufacturing, services, and more. The loss of momentum signals deeper problems. In the first quarter, Brazil's GDP growth was far below expectations. The once vibrant growth that drew global investors is now elusive. This makes it harder to create wealth and tackle social challenges. Take the mining sector. Output fell in early 2025 due to lower global demand and domestic hurdles. This decline rippled through the economy, impacting jobs and local communities. Slow GDP growth means fewer opportunities, lower tax revenues, and limited wage gains. For citizens, the dream of a better life feels more distant. For investors, the environment is riskier and less rewarding. The GDP slowdown is the foundation of Brazil's current economic troubles. It sets the stage for the other challenges we'll discuss. Without growth, every other problem becomes harder to solve. The numbers are clear. Brazil's economic engine needs a jumpstart. Let's see how this stagnation affects the job market next. Behind the numbers are millions of Brazilians struggling to find work. In 2025, unemployment remains stubbornly high, especially among youth and in poorer regions. The slow economy isn't generating enough jobs. Many turn to informal work, street vending, gig jobs, just to get by. These jobs offer little security or stability. In cities like Salvador and Recife, formal employment is increasingly scarce. The lack of quality jobs is a major weakness. High unemployment reduces consumer spending, further slowing growth. It creates a vicious cycle. Less spending means fewer jobs, and so on. Social unrest and pressure on government resources are rising. For investors, a weak labor market signals weak consumer demand. Addressing unemployment is essential for recovery. The job crisis is not just a statistic, it's a daily reality for millions. Brazil's future depends on breaking this cycle. Next, we examine how inflation and interest rates add to the pressure. The labor market struggles are only one piece of the puzzle. Brazil faces a double bind: high inflation and high interest rates. Inflation erodes purchasing power, making life more expensive for families. To fight inflation, the central bank keeps interest rates among the world's highest. But high rates make borrowing costly for businesses and consumers. This stifles investment and slows economic growth. For example, a manufacturer in Santa Catarina postponed expansion plans due to expensive loans. Multiply this across thousands of businesses, and investment dries up. The result: fewer jobs, slower growth, and persistent economic malaise. Policymakers are stuck. Lower rates risk runaway inflation, but high rates choke growth. The trade-off is painful, and the path forward is unclear. For investors, high rates may make bonds attractive, but signal weak corporate profits. Inflation and interest rates are two sides of the same coin, squeezing the economy from both ends. The challenge is finding balance without tipping into recession. Every decision has consequences for growth, jobs, and investment. This environment breeds uncertainty and caution. The pressure is mounting on both households and businesses. Next, we turn to the growing burden of public debt. Brazil's rising public debt is a storm cloud over its economy. The government spends more than it collects, borrowing to cover the gap. Debt as a share of GDP is climbing, raising alarms among economists and investors. High debt limits the government's ability to respond to crises or invest in growth. Servicing this debt is costly, especially with high interest rates. More money goes to interest payments, less to schools, hospitals, or infrastructure. Projects like a key railway in the Center West were postponed due to budget constraints. Short-term savings hurt long-term competitiveness. Rising debt raises fears of fiscal instability and potential credit downgrades. Investors worry about higher taxes and lower profits. The debt burden makes Brazil a riskier place to invest. Fiscal discipline is now more urgent than ever. These challenges don't exist in isolation, they're deeply connected. Slow GDP growth leads to high unemployment, which weakens consumer demand. Weak demand keeps inflation in check, but also stifles growth. To fight inflation, high interest rates are maintained, but they further slow the economy. Rising public debt is fueled by low growth and high social spending. High interest rates make debt more expensive to service. The government faces tough choices: cut spending or risk more debt. For investors, risk is systemic. A problem in one area quickly spreads. Stock market prospects are tied to interest rates and consumer demand. Bond investors worry about debt sustainability. Direct investors must assess the entire economic landscape. Understanding these links is crucial for smart investment decisions. Brazil's challenges are a domino effect. Addressing one means tackling them all. The need for a comprehensive solution is clear. Let's look at what recovery could look like. Is recovery possible? Yes, but it requires discipline and coordinated action. The first step? Bring inflation down gradually, restoring confidence for businesses and consumers. Fiscal discipline is essential. Stabilize and reduce the debt-to-GDP ratio. This reassures investors and lowers Brazil's risk profile. Support job creation and investment by streamlining regulations and reducing bureaucracy. Encourage private investment in key sectors and foster a more flexible labor market. Lean into Brazil's export strengths, agriculture and industry, to drive growth. Promote trade and seek new markets to offset weak domestic demand. The 2025 slowdown is a cycle of interconnected problems: slow growth, unemployment, high rates, inflation, and debt. Breaking the cycle requires a balanced approach on all fronts. For investors, the risks are real, but so is the potential for recovery. Brazil's comeback will be gradual, not instant. Watch for steady progress on inflation, debt, jobs, and exports. The path is tough, but the opportunity remains. Brazil's future depends on bold, consistent action, starting now. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.